Joining me now is Ares co-founder, president, and CEO Mike Arougheti. It's great to have you.
Good morning. It's good to be here.
So the current debate just in the macro land is how much progress we've made, and is it enough for the Federal Reserve to start cutting rates, and what that might mean for the market. What's your view on this?
The good news about the business we have is we have investments in thousands of middle market companies and real estate assets and infrastructure assets here in the US and around the globe. I guess the good news, bad news is everything we're seeing in our portfolios would tell you that the economy is still on really solid footing. To put that in perspective, in our middle market corporate lending books, we're seeing 10% plus cash flow growth. In our private equity portfolios, we're seeing 13 to 15% cash flow growth. In our real estate industrial portfolios, 40% year-on-year lease growth. So there's a lot of fundamental strength in the economy.
How much of a downturn?
Despite the GDP print last quarter, we're not seeing it. So that would tell you higher for longer. And that's been our base case now for quite some time. And I think the market is beginning to digest that reality. 2, labor force participation still very high, labor market tight, unemployment in a good place. So, that's going to keep some pressure on rates. There is a political overlay. I think it's hard to act aggressively in an election year. So I think there's going to be, a bias to not acting. And then lastly, a big conversation happening here, which I think is important, is just structurally, when you look at the Treasury market, are we in a place where the long end of the curve is just naturally going to stay higher for longer as well? So,
and is that your base case?
It is. Yeah, it is.
Higher for longer because the economy's in good shape, or because fiscal worries?
It's both. I think they're two, currents that are amplifying each other. I think it's also important when you think about rates, whether it's down 25 or down 50, you have to underwrite, I think, a higher neutral rate. And we need to adjust to an interest rate environment that's not zero. And so whether we land at Fed funds 3, 3.5, or 4, we're still going to have a lot of transitioning to do in the economy and in some of the asset markets that we play in.
Well, let's talk about where you play in private credit and the explosion that we've seen. Does this backdrop mean that it will keep growing, or is it getting a little crowded?
Well, again, there's structural and there's cyclical things at play here. So structurally, the private credit markets, in my opinion, will continue to grow quite naturally, both in corporate and real assets. That's a function of just the growth and maturation of private equity. It speaks to some structural changes that we're seeing in the banking market with assets leaving the banking markets. It speaks a little bit to long-term trends in public versus private. So you have real structural, secular tailwinds. And then cyclically, right now, private credit is offering very attractive risk-adjusted returns. It's floating rate. It benefits from higher rates. So you're seeing big capital allocations that are coming out of traditional fixed income portfolios, and in some cases private equity, and moving into private credit.
But with everybody getting into private credit, isn't it becoming more competitive for the good deals?
I think that's a little overblown. If you look at the size of the addressable market, it's still quite small relative to the amount of capital that's been raised. And you can look at that either in terms of private credit relative to the liquid fixed income market, or the amount of dry powder in the private credit market relative to the private equity market. And any way you look at it, despite the growth that we've seen, there's actually still a lot of room to grow.
What about within private equity right now? How big of a growth business is that for you, given the higher for longer outlook?
Yeah. All of my private equity colleagues always, get mad at me when I say to you that private equity isn't a growth business. That doesn't mean it's not a great business for us and that it's not growing, but you run a private equity business differently than you run a credit or a real estate business. Much more episodic, intense, active management. So it's a big business for it. It's about $30 billion business and growing. Private equity as an industry is having a little bit of a difficult time right now. Obviously, there was a significant amount of private equity that was raised and deployed going into the rate hiking cycle. And now, given where valuations are in this rate environment, that market is still a little frozen. We are beginning to see it unfreeze now that rates have stabilized. Obviously, if they start to drift down, that'll accelerate transaction volumes.
Speaking of rates stabilizing, Bruce Flatt was here of Brookfield Asset Management, said the commercial real estate stress story was last year's story. He says it's bottomed and activity is picking up. You play here too. What do you
do. I would generally agree. Again, real estate is a huge global addressable market. It matters what geography and what asset type you're talking about, right? So there are still going to be pockets of stress given the amount of leverage in that system, given who holds some of those loans, whether in CMBS or on bank balance sheets. But I would agree with rate stability and with economic strength, we are beginning to see transaction volumes pick up on the real estate side for sure.
On the private credit, one question about market share versus the banks.
Yep.
And what's happening there, how much you're taking, and whether you think that's going to attract some regulatory attention.
I don't. Again, I think it's a really good story and a good headline, but the market that we're competing with the banks is such a small sliver of what we consider to be the private credit market. And really what's happening there is just a shift of share from the leveraged loan and high yield market to the upper end of the private credit market. That's a very tiny percentage of what we would perceive to be the opportunity in private credit. And for the last 20 years, when the banks de-risk, either because of rates or credit losses or unsold inventory, the private credit markets have consistently come in to support
pick up
those
the slack. Yeah.
I think that's good, right? It's a stabilizing factor with private markets coming in to, infuse capital into those markets. So I don't perceive it as a...
Do you think it's why we haven't seen a bigger downturn in this cycle? And
absolutely.
And then no default cycle really to speak of either?
You have two things which are both part of the same narrative. One, private capital is there to come in and stabilize those markets. And two, as a result, if you look at how banks have participated as agents in these markets, there are fewer retail holders and fewer desks holding inventory. So you're just seeing significantly less volatility in the market. So, we don't talk about this enough. If you look at the pace of rate increases, and prior cycles, you would have had retirees owning big fixed income portfolios and suffering huge losses. When you look at who owns those assets now, there's been a transfer of that risk into markets that don't need that liquidity. And so you just haven't seen assets getting dumped into the market. That brings the entire market down. And I think when the story of this cycle is told, that stabilizing effect of private markets with it.
It's going to be key. Yeah, so that's, certainly not being talked about. Also, wealth business is growing for you. Where do you play here? Because we have tons of competition from the banks.
Yeah, we have one of the largest wealth platforms for alternatives, and that is a very large growing market. Obviously, if you go back 10 or 15 years, this was only the purview of institutions. Only the largest, most sophisticated institutional investors could access what we do. And we and others have been working with the banks through their wealth management platforms to package and deliver alternatives into that market. It is a huge addressable market. I think generally speaking, the retail investor is under-allocated to alternatives. And as they begin to understand what alternatives can do, both in terms of return and helping to manage their retirement, they'll see more pickup. We raised about $3 billion in the wealth channel in the first quarter alone.
I have to ask you about your latest investment in Orioles.
Yes.
You became a minority owner. You're from New York.
I am.
But you have an opportunity here to own the team with David Rubenstein.
Yes, huge.
What's the plan?
Hugely excited. Plan is to win a World Series. As David and I we like baseball. We like to win. The good news is, so far so good. It's been a great partnership. The team's performing well. We're having the time of our lives. So hopefully the season will continue to be on the same trajectory it's been for the first 30 games.
All right, Mike. Thank you very much. Good to catch up with you. Mike Arougheti from Ares.